Good morning, everyone. Nice Thursday morning here in sunny Lanarkshire. We're going to be kicking off today with our webinar on keeping more of your earn in 2023. Your presenter today is me, Chris Wilson. I'm a director here at Benson Wood & Co. And I'll take you through the various tax changes that are coming into effect in 2023 and beyond, how you might prepare both yourself personally and your business's affairs to maximise your earnings and minimise your tax bill. If you get any questions throughout and at the end, we'll have some time to cover these, and please feel free to use the Q&A function in the box. So topics we're going to cover today are business tax planning, which is going to break down into the corporation tax rise, came into effect in April, capital allowances, R&D tax credits. Then we'll focus on personal tax planning, looking at the tax freeze and impact of inflation, capital gains tax annual exemption, and changes to dividends. Sorry about that. So substantial changes ahead in taxation. This year, several significant changes to taxation. These include the increase to corporation tax. So from April 2023, there's a new top rate of 25%. In addition to that, there's been further reforms in research and development tax credits aimed at tackling abuse. This includes a reduction to the SME scheme rates. And also there was the end of the super deduction for capital allowances that finished in March 2023. There's been a reduction to the dividend allowance for this year and beyond, and also the capital gains tax annual exemption. There's a continued freeze on personal allowances and this relief until 2028. And also the making tax digital for income tax for self-assessment has been delayed again until 2026. It's important to utilise all the tax relief and allowances available to you before the end of the tax year on 5th of April, and to minimise your personal liabilities and also the company year end for your incorporated businesses. So with many of the changes now in effect, it's important to take steps and in good time. We're nearly at the end of June just now. If your company year end was July or August, please contact us about carrying out a pre-year-end review with you, and we'll look to maximise your savings there. There are lots of strategies and actions you can take to manage your tax bill, but careful planning is needed to make sure you strike the right balance. So let's start by looking at what steps you can take this year. Business tax planning. Corporate tax is a complex area, and business owners need to consider their current position carefully before year ends, as it may be necessary to balance their own needs and desire to earn more from their business with existing tax saving opportunities for their company. So the areas that I'll be considering are dividend taxes, corporation tax, capital allowances, and research and development tax relief. So as I've mentioned, there has been a rise in corporation tax. So we're looking to see if you've made use of all the relief and allowances available to you. Some of these I'll cover later, such as capital allowances and research and development tax credits. But managing your corporation tax bill had never been more important. So the rate of corporation tax was 19% up to 31st of March 23, and that's going to increase for companies that have got profits of more than 50k to as much as 25%, with businesses where profits are over 250,000. Businesses where your taxable profits are between these thresholds will fall into what we call kind of the marginal rate, and there'll be some marginal relief to claim on there. But be aware, these rates, so the thresholds from 50 to 250, that will be prorated if your company year doesn't align with the tax year, and also further it will be reduced if you have more than one company, what we call associated businesses. So if you've got another subsidiary or related business, these would be reduced to 25 and 125,000. But given these changes, you want to consider carrying forward the losses into the new tax year, which to reduce your overall levels of profitability. Basically, that means if you've got tax losses in the company, you've possibly got the option to carry back. So you can carry back and reclaim the relief at 19% and get the cash position just now. But it may make more sense tax-wise to actually carry these forward and save tax at a higher rate. What you also want to consider as well is if your business can experience seasonal profits and you're going to realise larger gains at different times, you may want to assess your accounting periods and plan for when certain business is going to take place, so that you can accommodate that with relative expenses and get it in the right period. Where we have the most success with clients is where we work with you on a quarterly basis and carry out pre-year-end reviews at least a month in advance before the year end. That allows us to help keep the finger in the pulse of your business and assist with proactive planning. And if that's something you've not currently got in place, then please contact us to help us set this up with you. The capital allowances. Capital allowances can be claimed by businesses and companies as a way of reducing their taxable profits. Capital allowances are claimed by companies in place of depreciation as a way of standardising the tax system. There is enhanced relief available under the annual investment allowance regime and the super deduction regime. The annual investment allowance, known as AIA, is a form of tax relief for businesses that is designated for the purchase of business equipment. The AIA allows businesses to deduct the total amount of qualifying capital expenditure up to a certain limit from its taxable profits in a given tax year. You can claim AIA on most plant and machinery up to the AIA amount. If your business buys a piece of equipment that qualifies for AIA, you can deduct 100% of that cost from the asset from your business's profit before you work out how much tax is due on that profit. The government sets a limit on how much annual investment allowance a business can claim in a year, which means if you buy assets costing more than a limit, you won't be able to claim the AIA on all your assets. Back in 2019, the limit was previously 200,000. That was then temporarily increased to 1 million, and it's now been set permanently at that level. Things that you can't claim annual investment allowance on are cars, items you've owned for another reason before use in your business, and items given to you or your business. If you can't make a claim for these reasons, you could use writing down allowances instead. Up until recently, many businesses could also rely on the super deduction, which applied from the 1st of April 21 to the 31st of March 2023. Companies investing in qualifying new plant and machinery assets would be able to claim 130% super deduction capital allowance on qualifying plant and machinery investments, or a 50% first year allowance on qualifying special rate assets. Since April, this has now been replaced with a new capital allowance known as full expensing. This offers 100% first year relief to companies on a qualifying new main rate plant and machinery investments from 1st of April 23 until 31st of March 2026. This can be claimed in the same year that the investment is made, and this will run alongside the annual investment allowance. The government also provided a 50% first year allowance for expenditure by companies on new special rates, including long life assets, until 31st of March 2026. Like the super deduction before it, full expensing is only available to companies subject to corporation tax. Therefore, unincorporated businesses cannot claim, but such businesses are entitled to claim the AIA, which offers the same benefits as full expensing up to $1 million per annum limit. Visit our website or contact one of us to find out some more on that. As mentioned, firms can also benefit from the main rate pool, special rate pool, and SBA, structural businesses, buildings allowance, which are all writing down allowances. If a company is eligible to claim capital allowances on an item, the rate will either be at 18% or 6%, depending on what type of plant it is or if it's a special rate. If incurring expenditure on property, then relief may be available at 3% under the structure and buildings allowance. That's getting the capital allowances and writing down allowances. I'm now going to move on to our research and development claims. So as a business, we support clients in a variety of sectors in claiming their research and development tax credits. Back in April 2000, HMRC launched the Research and Development R&D tax relief scheme, specifically to reward UK businesses making scientific and technological developments as an enhanced claim that counts as notifiable state aid. 20 years on from its introduction, many companies who could be eligible are still failing to claim this valuable relief. Research and development R&D tax relief or credit is a company tax relief that can either reduce the company's tax bill or for some companies provide a cash sum. Research and development credits are available to large, small and medium-sized companies. Depending on whether the company has taxable profits, these can result in either a cash repayment for the company, which helps the cash flow, particularly when the expenditure results in a loss. This scheme has been very successful, but in recent years there's been accusations of abuse, which meant that the rules were reformed in April this year. So do you qualify? So to qualify for R&D tax credit, a company must be carrying on a project that seeks an advance in science or technology. It's necessary to state what the intended advance is and to show how, through the resolution of scientific or technological uncertainty, the project seeks to achieve this. The advance being sought must constitute an advance in the overall knowledge or capability in a field of science or technology, not that of the company alone. So what counts is research and development R&D expenditure. So direct and externally provided staff, subcontracted staff, consumables, software, trials, prototyping, and independent research costs may all qualify for R&D relief. Firstly, to look at direct R&D staff costs, your company can claim for salaries, wages, employers' national insurance, pension fund contributions, and staff directly engaged in the R&D project. This covers employees who undertake hands-on R&D work and the proportion of their supervisory and managerial time spent specifically directing such employees on those activities. Support staff costs, for example, administrative or clerical staff, do not qualify, except when they relate to qualifying indirect activities. You cannot, however, claim for employment-related benefits. Looking at subcontractor costs and externally provided R&D staff, these are the staff costs paid to an external agency or staff who are directly and actively engaged in the R&D project. Relief is usually given at 65% on the payments to be made to the staff provider. Special rules apply if the company and staff provider are connected or elect to be connected. The company may claim for the cost of software that is directly employed in the R&D activity, where software is only partly employed in direct R&D. An appropriate apportionment should be made. Finally, consumable items. Your company may claim for the cost of items that are employed and consumed in qualifying R&D projects. These include materials and the proportion of water, fuel, and power consumed in the R&D process. Since April 2015, the cost of materials incorporated in products that are sold are not eligible for relief. What doesn't count is R&D expenditure. So not all costs qualify, and you cannot receive R&D relief for the cost of land, the production and distribution of goods and services, capital expenditure such as plant and machinery. However, a separate research and development allowance may be due on capital assets such as plant, machinery and buildings used specifically for R&D activity. Payments for the use and creation of patents and trademarks, as these are costs of protecting the completed R&D, not actually actively involved in the R&D activity. But there is, however, potential patent box relief available, but we're not covering that here today. So if you've got queries on that, please contact us. So the SME scheme. HMRC has two schemes for claiming tax relief. The main one looking at and deal with mainly is the small or medium-sized enterprise scheme, known as the SME scheme, and the research and development expenditure credit scheme. So to be considered as an SME, HMRC, for these purposes, your business must have less than 500 staff and either a turnover of under 100 million or a balance sheet total of under 86 million. These limits apply to your whole corporate group if you're part of one. For periods up to 31st of March, the SME R&D tax relief allowed companies to deduct an extra 130% of their qualifying costs from their yearly profit, as well as the normal 100% deduction, to make a total 230% deduction. So, for example, if a business spends £10,000 on qualifying R&D expenditure, within the tax computation, they'll be entitled to an additional £13,000 worth of tax relief, resulting in total tax relief on 23,000. The relief obtained on the 23,000 is 4,370, which equates to roughly 43.7% on the initial qualifying expenditure. If the company is loss-making, you can instead make a claim for a payable tax credit worth up to 14.5% of the surrendable loss, which results in tax relief of round about 33.35%. Well, the R&D tax credit scheme is a tax relief. Its benefits are numerous. For example, the recovered funds do not have to be used in a specified way, and so can be reinvested further into R&D or be used for purchasing new machinery, materials, technologies, or invested generally to help the business growth. The RDEC scheme replaced the large company scheme in 2016. It works very differently to the SME scheme, as the credit is entered into the financial statements of the company. RDEC must be claimed by businesses that qualify as large, but in some circumstances will also be claimed by SMEs who have been subcontracted to do R&D work by a large company who have received a grant or subsidy for their R&D project. The credit is calculated at 13% of your company's qualifying R&D expenditure. If the expenditure was incurred on or after 1st of April and is taxable. Different rates applied prior to April 2020 and were either 12% or 11%, depending on when the expenditure was incurred. Depending on whether your company is profit or loss making, the credit may be used to discharge the liability or result in a cash payment. The RDEC is a tax credit, and you can make a claim up to 2 years after the end of the accounting period it relates to. How to make a claim. What you'll need to provide to support your claim, as well as calculating the figures. In order to support your claim to HMRC, you will need to provide a short summary that explains how your project meets HMRC's definition of R&D. As a reminder, these are that the project looked for an advance in science or technology and aimed to achieve this advance. The project had to overcome scientific or technological uncertainty and how you overcame this uncertainty. And finally, it could not be easily worked out by a professional in the field. As I mentioned earlier on, there was further reforms that have been brought in since the 1st of April 2023. The new rules for R&D tax relief claims will require businesses to submit a pre-notification of their claim to HMRC digitally. This applies if a business is a new claimant, it's your first one, or if you've not claimed within the past 3 financial periods. The requirement to pre-notify HMRC will affect any business that conducts research and development if they're able to claim either under the R&D expenditure credit, RDEC, or the SME R&D relief schemes. The changes will predominantly affect SMEs, as they are more likely to be first-time claimants of the R&D tax relief. This is part of a wider package of reforms, which also includes R&D reliefs will be focused on the UK from 1st of April 2023, and all subcontracted R&D work and the cost of externally provided workers will be limited to work undertaken in the UK. Businesses will be able to include the cost of purchasing data for R&D projects or using cloud computing services within a claim. Also, from 1st of April 23, the rates of relief offered by this initiative will also change as follows. The additional deduction rate for SMEs will be reduced from 130% to 86% to make a new total deduction rate of just 186%. The SME credit rate will also decrease from 14.5% to 10%. The RDEC credit rate will increase from 13% to 20%. Meanwhile, profit-making SMEs will see the amount they can claim reduced in real terms by 13%. The caveat to this was in the spring budget, the Chancellor made a concession for R&D intensive SMEs. Under this new measure from April, the enhanced R&D tax credit of 27% will be available to loss-making R&D intensive SMEs. That's those who spend 40% of their total expenditure on qualifying R&D. Eligible companies will be able to claim cash repayment of 14.5%. The general reductions to the rates of relief available under the SME scheme come at a time when corporation tax rates are rising for more profitable businesses. It's therefore important to calculate the impact of these changes on your investment plans. I've put together some key questions that were helpful for you to consider if you think of applying for R&D relief. Have you developed your own software? Have you developed internal processes that reduce costs and improve production time? Do you carry out design work that enhances technology? Are you in the business of manufacturing products? Are you using existing technologies in a unique way? Are you combining two or more existing technologies in a way that have never previously been used? Do you have any pending patents for products or services that could qualify? We work with a team of specialists, and if you're unsure whether you qualify for any of the above, please contact me and we can arrange a meeting to discuss. Now that we've covered that R&D, we're now going to move on to business tax planning and other areas to consider. There are a variety of ways for businesses to further reduce their annual tax bill while supporting their other goals, such as employee recruitment and retention. So these cover salaries. So considering the payment of salaries to owner managers at tax efficient levels, bearing in mind revised national insurance thresholds, and also making efficient use of the employer's allowance. Benefits. There are a wide range of benefits and salary sacrifice schemes available to employees and directors, such as electric cars and charging points. Electric cars are a tax-efficient way of remunerating key personnel. Benefits in kind on electric cars are currently 2%, which is significantly less than petrol or diesel vehicles. EMI share schemes. So EMI means Enterprise Management Incentive. These are a tax-efficient way of giving shares to key staff to help retain them and provide a sense of ownership. The scheme is ideal for smaller entrepreneurial companies that might not be able to match the salaries paid elsewhere. Expenses. A bit of an obvious one, but have you made sure that you and your team have claimed all the eligible expenses for the year? Incorporation. If you're trading as a sole trader, a partnership, or LLP, you might want to consider whether incorporation to a limited company would mean a more tax-efficient business structure for both now and in the future. Profit extraction. Are you making the best use of opportunities through the likes of dividends to extract profits from your business? or now does it make more sense to change the mix of how you draw salary and dividends? This will vary for business owners across the board, as there are several factors to consider. And if you'd like to review this further, please don't hesitate to contact me. For personal tax planning, there's a few personal tax planning points to consider that may help you reduce your overall bill. The threshold for the additional rate of income tax is fallen from 150,000 to 140 from April 2023. So this will put thousands of more people into the additional rate tax bracket. In the UK, that's 45%, but here in Scotland, that's 47%. And for general income, and 39.35% for dividend tax, which is UK-wide. Will this change affect you? And how much tax will you have to pay in the future? Inflation is likely to drive many owners into the highest tax bracket for the first time. Therefore, planning is critical. Interspouse transfers. Have you maximised capital gains release and potential income tax release through exempt transfers? This is mainly for individuals whose income is between 100k and 125k, and it can be a powerful way of reducing your tax liabilities. Exchanging your salary for benefits. So you could consider exchanging part of your salary for payments into either an approved share scheme or possible additional pension contributions to take you below the 100k threshold. Company car. Is it time for a new car? And have you thought about switching to an electric vehicle? And that could substantially reduce the amount of benefit in kind tax that you pay. Dividends and bonuses. Consider the timing of these. The dividend rate, as we'll come on to, was 2,000. It's now reduced down to 1,000. So you want to make sure that you're making effective use of that across the board. Anything in excess of the dividend allowance is taxed at the marginal rate of tax. So these days, that's going to be 8.75% if you're at a basic rate, 33.75% a higher rate, or 39.6% if you're an additional rate taxpayer. As I mentioned just briefly, dividend allowance has fallen to 1,000 from April this year, and it's going to fall again to 500 next year. So it's very important that you use up all of that £1,000 in this current tax year. Directors' loans. Have you loaned money personally to your business? And are you making use of effective interest that you can charge on that? Depending on your income setup, you could save up to £1,000 in tax that way. Other thing to consider is stamp duty land tax, depending if you're purchasing a home, a second home. The additional dwellings duty since December 22 up here in Scotland is now 6%, and it's an important factor to consider. And tax freeze. So the government has further extended the tax freeze on personal tax allowances till 2028. This means that millions of taxpayers are likely to be pushed into higher tax bands as inflation affects their wages and income. Have you considered how this is going to affect you? Capital gains tax. Beware that the exemption has been more than halved to 6,000 from April 2023 and reduced further to 3,000 from April 24. This will drastically affect the disposal of assets, particularly during the sale of a business, shares, or property. It will also mean that a lot more capital gains will have to be reported to HMRC, even when no capital gains tax is due. CGT is taxed at a rate of either 18%, 20%, or 28% for regular assets and property. There is a reduced rate, which falls under business asset disposal relief. This was formerly known as entrepreneur relief, and the lifetime limit for that was reduced previously from 10 million to 1 million. So if you qualify for business asset disposal relief, any games will be taxed at 10% as opposed to the 18%, 20%, or 28% rates. But it's worthwhile seeking advice significantly before any potential disposal to discuss whether that disposal will qualify for the business asset disposal relief, and if not, what can be done to change the situation. Equally, if the disposal would currently qualify, you want to know that it will continue to qualify. Dividend tax. As we've touched on, we wanted to check that you've used the 0%, the £2,000 allowance in 2023. 23 is gone now and we're reduced to the 1,000, and that's going to reduce again to the 500. So again, it emphasised the importance of using these allowances in the tax year. Looking ahead, you may want to reassess how you're remunerated so that you continue to enjoy tax efficient income from your business. Again, please contact us if you'd like to review your structure and your options from withdrawing further funds from the business. As well as focusing on the year end, you also need to make sure you've got plans in place for the future, especially if you're among the growing number of people likely to be affected by inheritance tax. Here are some steps you can take. Charitable gifting. If you leave at least 10% of your net estate to charity, a reduced rate of 36% rather than 40% applies and could save your family money. Speaking to some of our charity clients, they've asked that if you choose to leave to them something in your will, that you could let them know and they can plan for the future. Annual gift allowance. You can give away £3,000 worth of gifts per person each tax year without them being added to the value of your estate. This allowance can be carried over 2 years if it's unused. Larger gifts above the allowance will be subject to the 7-year rule. Gifts out of income. That's your disposable income. So you can make regular gifts out of your income, which are tax-free if they're used for normal expenditure, which could include paying for a grandchild's school fees. Passing on your pension. You should revisit your current plans and update your will to ensure that your family receives the full benefit of any remaining pension fund. Be aware that the changes to the tax-free pension allowances may mean that you can now pass on more via a pension than you previously thought. Trusts. There are many ways that a formal trust can protect and maximise your family's future assets. There are a number of changes to the treatment of trust funds recently, which are complex and could affect some people. No one ever wants to see their hard-earned pension targeted by the taxman, so you should consider the following. Protecting your pension. The lifetime allowance has changed considerably in recent years and will now be abolished entirely from April 2023. This means you can save as much as you like within the confines of the annual pension allowance, tax-free. The annual pension allowance. If you use your full pension allowance, you can now invest up to £60,000 a year into a pension tax-free, which was previously £40,000. This amount can be carried over 3 years, allowing you to use unused allowances to top up your pension. So for now, you could invest up to £180,000 in a single tax year if you've not invested previously, but you had a pension open for contributions in these years. Stakeholder pension. All UK residents, including children, can make annual net contributions of £2,880 per year. That works out as £3,600 gross, whether or not they've made any earnings. Pension drawdown. If you're 55 or over, you may be able to start drawing down your pension benefits now from a personal pension such as a SIP, even if you're still working, and you may take up to 25% tax-free with the rest taxed at your marginal rate. Tax-efficient investments. There are a wide range of tax-efficient investment options which can help reduce your liabilities. Are you using or have you considered the following? ISAs. Most people are aware of cash and stocks and shares ISAs. However, you may not be aware of Help to Buy ISAs, Lifetime ISAs, and Child ISAs. Help to Buy ISAs are in place specifically to assist people in purchasing property for the first time. Lifetime ISAs can be used as to purchase a first home or for later life planning. And child ISAs are an efficient way of transferring value from one generation down to the next before the child reaches 18. One of the main benefits of cash ISAs and their investment-based alternatives are that you won't pay any income tax or capital gains on your returns. Some savers choose ISAs for this reason alone. There are other potential advantages to consider, and these include the following: tax-free withdrawals. You can withdraw funds from both your cash and investment ISAs without incurring a penalty. Wide investment choices. ISAs offer a wide range of investment choices. Transferable. ISAs are highly portable. It's possible to switch from one provider to another to take advantage of superior interest rates and deals. You could also transfer your funds from a cash-based ISA into a stocks and shares account, and vice versa. There are usually no wrapper charges or extra charges with an ISA, and the income you earn will not be taken into account for age-related personal allowances. Inheritance. You can usually pass your ISA savings on to a spouse if you were to pass away through an inherited ISA allowance. Share schemes. Share option schemes are typically used as an incentive for employees. A share option is the right to buy a certain number of shares at a fixed price, some period of time in the future within a company. They can then keep the shares, or if the market price is higher, sell them at a profit. SEIS, that's the Seed Enterprise Investment Scheme. SEIS targets investment for early stage companies, those with less than 2 years trading history and under 25 employees. Individual investors, not companies, can invest up to £100,000 in an SEIS business per tax year. SEIS companies can accept no more than £150,000 in SEIS funding total. EIS, Enterprise Investment Scheme. EIS supports larger, more established businesses, those with up to 7 years trading history and up to 250 employees. Individual or corporate investors can invest up to 1 million per tax year. The company can accept up to 5 million per tax year and no more than 12 million EIS funding in total. However, corporate investors in EIS do not receive tax relief on their investment. Venture Capital Trust Investment, VCTs, are investment companies that are listed on the London Stock Exchange and set up to invest in small UK businesses that meet certain criteria. To encourage support for these businesses, the government offers generous tax benefits for VCT investing. This also reflects the higher risk nature of the companies they invest in. Community investments. Community investment supports local enterprises to improve people's lives and communities where they operate. Small businesses are essential in disadvantaged communities across the UK, both as employers of local people and drivers of economic activity. Social and enterprise investments. Social investment is repayable finance provided for charities and social enterprises. That means it is not a grant, but it's money that the investor expects to get back, often with interest. Life assurance bonds. Investment bonds are a type of life insurance paid for with a single lump sum deposit at the outset, rather than monthly premiums. They're sometimes known as single premium life insurance policies. Offshore bonds. These are also known as international bonds. They're a tax-efficient way for you to invest money over the medium to long term. This is usually over 5 years or more. With an offshore bond, you can invest a lump sum or invest regular payments. Succession planning. Are you thinking about selling a business or part of a business as part of your succession plan? You need to consider the personal and business tax implications of a sale. The sale of shares could lead to capital gains, while selling part of your business or assets could create chargeable gains for corporation tax. One option is a management buyout. If you're seeking a management buyout, the structure of the transaction could have a substantial impact on how much tax each party pays. Have you considered how the new management will be remunerated? Will the sale be achieved through shares or assets? Are the deal costs tax deductible? Is stamp duty due on the transfer or sale of property? Business asset disposal relief. If you're looking to sell your business or shares in your business, and this leads to a capital gain, you could be taxed at a rate of up to 20%, depending on your marginal tax rate. Business assets disposal relief, formerly known as entrepreneur's relief, could reduce this tax rate to just 10%. Passing a business on to a family member. Gifting a business or shares in a business to a family member is still considered a disposal for capital gains tax. Depending on when you pass on, after gifting a company, the value of its shares and assets could be included in calculations for inheritance tax, but you could take advantage of business property relief. The relief reduces the value of a business or its assets by up to 100%. Have you considered the implication of transferring the business to your family? Yeah, thank you for listening. I know that was a lot to get through, and there was a lot of detail. I'm not sure if there are any questions in the chat box. Joe, is there any questions?
There isn't at the moment, Chris, no.
No problem. Okay, if there's no quick questions at the moment, and if you're watching this back later on, what I would say is we're here to help and standing by to take your call or email and come back to you and arrange a meeting. Please see our details there. If you want to email us, it's mail@benson-wood.co.uk, and our contact telephone number is 01236 756 161. We'd love to get a chat with you, arrange a meeting with you, and go through the opportunities you're looking at to maximise your earnings and also minimise your tax liabilities. So thank you again for your time today.